Ladies and gentlemen, good day and welcome to the earnings conference call for Syrma SGS Technology Limited, hosted by JM Financial Institutional Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shalin Choksey from JM Financial Institutional Securities Limited. Thank you, and over to you, sir.
Thank you, Navya. Good morning, everyone. On behalf of JM Financial, we welcome you all to the Q4 FY’25 earnings call of Syrma SGS. Today, we have with us the senior management of Syrma SGS. I will now hand over the call to Nikhil to take the call forward. Thank you, and over to you, Nikhil.
Thank you, Shalin. Hi, very good morning to all. Welcome to Syrma SGS Q4 and fiscal year 2025 earnings call. We have with us today Mr. J.S. Gujral, Managing Director, Mr. Jayesh Doshi, Director, Mr. Satyendra Singh, Chief Executive Officer, and Mr. Vijay Agrawal, Chief Financial Officer, Syrma SGS, to discuss the performance of the company during the fourth quarter and financial year 2025, followed by a detailed question and answer session. During the call, certain statements that will be made are forward-looking, which involve several risks, uncertainties, assumptions, and other factors that can cause results to differ materially from those in such forward-looking statements. All forward-looking statements made herein are based on the information presently available to the management, and the company does not undertake to update any forward-looking statements that may be made during this call. In this regard, we request please do review the disclaimer statements in the earnings release and all other factors that can cause a difference. With this, I will now hand over the call to Mr. J.S. Gujral, Managing Director, Syrma SGS. Thank you.
Good morning, everyone. A warm welcome to the Syrma SGS Q4 and FY’25 earnings call. I'll delve on the broader picture, the business scenario, and the macro level things affecting the company, and the quarterly numbers and the details will be dealt with by Vijay Agrawal in detail. We started off the year with a guidance of 7% of EBITDA, which was at about 310 and 315 crores. A recalibrating of the business strategy to bring consumer business down to about 35%. Which also means accretion in the business, high margin business of industrial, automotive, and healthcare. As we close the year, we find that we have achieved the target set and communicated to everyone. We have brought down the consumer business to 35%, 36% of our revenues. EBITDA expansion has been a bit healthy at 8.6%. Up almost 1.8% from FY’24. As we look forward for the coming years, we are in line to grow the business at about 30-35%, with consumer being retained at about 30%. So we further see a reduction in the consumer content from 35% to about 30% in the coming years. As a natural corollary, this would imply, or this means, that our superior margin business in the industrial, healthcare, automotive verticals would further go up, which would help us in sustaining the EBITDA margins of about 8% in the coming years. As we look back, we find that we have added about 20-25 new customers in the current year, which would go on stream this year and in FY’26-27. We have commissioned our Pune facility. We have commissioned our facility in Germany, consolidating it into one location. The facility was acquired somewhere in June, July, August last year. We have started large format box build for customers, global customers, which would accrue decent size of revenues in the coming years. We are fully on track in achieving the growth target for about 30-35%, which is backed by the orders in hand, with a focus on high margin verticals. Another issue which is of great satisfaction to us is that our ESG initiatives are on track, and EcoVadis, which is a global agency which monitors ESG, has given us a percentile score of +70%, and we are among the top 35 companies globally which are meeting the ESG norms set by the companies and the government. Our leadership training programs and induction of talent is almost complete now, and we are fully poised to grow the business and be a forefront runner in the EMS space, especially in the exports. Exports in the current year have been subdued. We had guided a 1,000 crore export target. We have fallen short by about 200. We are about 800 plus, largely driven by the tariff uncertainties, a muted EU environment. However, based on the guidance inputs received from our customers, we expect the exports to cross the 1,000 crore mark. So we are delayed by a year. We should have achieved it in FY'25. We intend achieving it in FY'26. We have generated a free cash flow of about 176 crores. Net working capital at about 69 days. Work in progress, scope for further reduction. Now, what gives us the satisfaction is that if we look back on 4 years sort of period, what do we see? Our revenues have grown by about 44% CAGR, EBITDA 34%, PBT 29%, exports 15%. And mind you, neither EU nor America is growing at that rate, which clearly indicates onboarding of customers or drawing more business from the existing customers. If I was to see the landscape of the verticals, in the last 4 years, my automotive in the segment has expanded by 57%, consumer by 60%, healthcare by 23%, and industrial by 29%. If I see only for the last year, FY'25 over FY'24, I have seen automotive increase of 26%, a decline, only increase of about 7% in consumer, in line with our target of bringing down the low margin, high volume consumer business content. Healthcare has gone by 15%, industrial by about 29%. And we believe that in the current year, consumer will be about 30% of my revenue, and remaining 70% will be industrial, which should be about 30%, automotive about 25%, healthcare and other things about 15-18%, and the balance by railways and IT. With that, I hand over to Bijay Agarwal to take you through the details, and any questions which you have, I'll be more than happy to address them.
Thank you, Rajan. Good morning, everyone. I will now take you through the brief financial performance of the company for the quarter and for the financial year FY'25. I can start with the revenue here. Our consolidated total revenue for the quarter is 947 crore, which has grown by 6% quarter-on-quarter. And similarly, the total revenue for the full year is about 333,836 crores. That grew by 19% year-on-year as against the previous year. The growth for the period is contributed largely by higher growth in the auto segment, industrial segment, and IT businesses. Our export revenue for the quarter is about 280 crore rupees, and for the full year it is around 860 crore rupees, which is approximately 23% of my total operating revenue. Our ODM revenue for the quarter and for the full year also, it is about 12%. The quarter, we have shown good rebound on the margins, led by expansion into the gross margin on the back of change in business mix, mainly lower consumer, as Mr. Gujral has explained, better industrial business, higher healthcare business, and our continuous effort on operational efficiencies and stable overhead costs. Our gross margin for the quarter is about 27.8%, and for the full year it is 22.6%, with a healthy expansion of around 200 basis points as against the gross margin of the previous year. Our operating EBITDA for the quarter stood at around 116 crore rupees, which is year-on-year growth of approximately 39%, and the operating EBITDA margin of 12.4%. Similarly, when we see the operating EBITDA for the full year, it is about 324 crore, with the operating EBITDA margin of 8.6%, which has grown almost 48% over the previous year. Same way, PBT for the quarter is 93 crore rupees with a PBT margin of 9.9%, and for the full year it is 239 crores, which is PBT margin of 6.2%. Our PAT for the quarter is 72 crore rupees with a PAT margin of 7.5%, and for the full year it is around 184 crores, which is 4.8% of PAT margin for the full year. Coming to the overall working capital performance, we are currently running at around 69 days of net working capital days of investment. While we continue to make our efforts to bring it down to below 60 days, maybe around 60, below 65 days, maybe around 60 days, but we'll be focusing on the same and targeting to bring those numbers in the upcoming year. Moving to our debt position, we have a total gross debt of around 611 crores at the end of the year. Largely working capital debt, which is around 520 crores rupees, and balance 90 crore rupees is a term loan. We continue to hold a healthy treasury balance of approximately 347 crores here, and with this, our net debt position at the end of the year is 264 crores. Our cash flows, primarily operating cash flow for the year is 170 crores positive, which is resulting into the OCF to EBITDA of approximately around 54%. Coming to CapEx investment, during the year we did almost 180 crores of CapEx, largely towards greenfield expansion of our Pune campus facility and some bit of brownfield expansion into Bawal and Chennai location, mainly driven through new customers onboarding and related tools and fixtures and plant and machinery installations. Coming to asset turn and the returns, we have achieved 5.5 times of asset turn during the year, and ROC is around 16% on an adjusted basis. We expect this to further improve as we set our assets, as we improve our overall asset utilizations gradually. Lastly, I would say we continue to focus on the high margin business verticals, operational efficiencies, overall cash flow improvement, and thereby improving the return. We still continue to focus upon the working capital improvement, and that's all from our side. I would now hand over the call to Navya to take it forward.
Thank you, Vijay. I now hand over the call to Mr. Satyendra, our Chief Executive Officer, to his comments on the business.
Thank you, Nikhil, and good morning, everyone. Thanks for joining the call. I think we have had a very good quarter as a company. First of all, I'd like to say thanks to all the 9,000 plus people we are employing in the company who work day in and day out, whole of the year and the quarter, to bring us the results which we have reported to you a few minutes ago. Overall, I think we continue to stay focused on the strategy which we have always outlined. Consistently, as a company, we are looking at the businesses which are medium volume and higher margin. Essentially, we continue to focus on automotive, industrial, medical, railways. These are some of the segments where we continue to focus on. Accordingly, the business mix will evolve, as Gujarat already highlighted, that consumer business will shift slightly down as a percentage. However, all our businesses will continue to grow. We have taken many steps to improve our operating efficiency, to improve our procurement efficiency, to ensure that we sweat our assets, as Vijay highlighted in his comments. That's key of EMS business. At the same time, it's not lost on us to ensure that we have enough capacity available. We will continue to invest as and when it is needed. At this point, we are evaluating our footprint, and we are expanding our Bangalore facility, marginal expansion to ensure that we are able to serve our increased business in Bangalore. Overall, I think we stay focused, and we look forward to results as in line with what Mr. Gujral highlighted. So thank you very much. Back to you, Nikhil.
Navya, thank you, Satyendra. Navya, you can help us on the Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, thank you for the opportunity. I have 3 questions. First, if you can elaborate a little bit more on what is troubling our consumer business, which product segment, and how is the current run rate in terms of exit? How do you look at it?
Sorry, could you please repeat the question again? It was not very clear.
Yeah. So what exactly is troubling our consumer business, and how is the exit run rate versus what we have achieved for the full year?
See, there's nothing troubling in the consumer business. We have always shared that the high volume, low margin consumer business is one of the low-hanging fruits which we had picked up. But with the conscious focus on concentrating on our core competencies, which is engineering, design-led manufacturing, which is more into industrial, healthcare segments. So there was a very conscious call of the management to recalibrate its focus on the high margin segments. And as I've already shared, there are no free lunches. When you concentrate on high margin verticals which have a lot of engineering design content, the natural casualty is the top line. So it's a call which the management has taken to have accretive EBITDAs from superior verticals.
Also, on the exit run rate, we have done around 190 crores of consumer revenue in the quarter 4, which is around 21%, while for the full year it is around 35%. The only clarification here is this is not like evenly distributed kind of a thing. The schedules come into one quarter probably much more higher number and one quarter much lower number that way. So from an exit run rate point of view, we should consider a full year revenue rather than a quarterly revenue.
I've always been maintaining that we should not look businesses on a quarter-on-quarter basis. If you recall, Q1, the consumer business constituted 54% of our revenues. Q4, it constitutes about 20% of our revenues. But on a blended basis, it has come down to 35% this year, and we further intend to take it down on an annualized basis to 30% in the coming year. Q on Q, there could be variations.
Sure. Thank you. On that note, while we are looking at full year numbers, our consumer business will go down further in terms of mix from 35 to 30. So what would drive the EBITDA margin decline from 8.6 to 8 as we have guided for FY'26?
See, we have guided 7%. We have delivered 8.6 or 8.5, whatever is that. We are guiding 8%, which is almost a 15% increase on 7%. As the quarters pass by, if we believe and we are confident to achieve a EBITDA of higher than 8%, we would share with that. currently on a conservative basis, we guide 8% EBITDA margin. We guided 7% last year, and we are now guiding 8%.
Also, when we see there's a consumer business coming down to 30%, but simultaneously maybe IT plus automotive business will also increase slightly a bit higher in this overall mix. And based on the weighted average mix only, we are guiding about 8%.
Sure. A couple of housekeeping questions. One, both receivable and payable days have increased. So what is driving this sharp uptick? I understand the overall working capital is still under control of about 69-70 days, but the mix has shifted. So what is driving this?
Vijay will run through the figures. You see, in working capital, I think the quality of working capital is reflected by the lower inventories. So what we have achieved this year, we have brought down our inventory levels by about 18% to 822 crores, down from about 1,000 plus crores. Payables and receivables are commercial transactions which we as a strategy try to match off. So if my customers ask for extended terms of credit, what is under my control is have a efficient manufacturing and bring down the inventory levels, which we have done 18% this year. We go back to our vendors, and as our volumes increase, we go back to our vendors for extended payment terms. So that's a commercial balancing of receivables and payables. So this is the part and parcel of the business environment. What is critical is my inventory under control or not? And there I'm happy to share our team has done a phenomenally good job of reducing inventory by about 19%. I hope that answers your question.
Yes, it does. Lastly, if you can give us the order book numbers. Right.
Vijay will take you through the numbers, but on a macro level basis, whenever we guide a revenue, it is based on the orders in hand and orders in pipeline and visibilities and everything. So order book is in line with what we have guided. But for the specific numbers, if you want, Vijay will share with you. He has the details he can share with you. But broadly, I think our orders in hand are in line with the revenues guided. So we can derive the figure. If you want it from Vijay, he can share it with you.
So broadly, as Mr. Gujral has explained, order book is in line with my revenue guidance. But still the overall order book is somewhere between 5,200 to 5,400 crores as of now, which is as of 31st March 2025. And in which the breakup would be around 25 to 27% is auto-related business, approximately 30% consumer business, industrial would be around 28 to 30%, and rest 15% is approximately between IT, healthcare, and railway business.
Sure. Thank you so much. That's all from my side.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit your questions to one per participant. We will take the next question from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Hello.
Hi.
Can you hear me?
Yes, please.
Yeah. So thanks for the opportunity. So two questions. Should we consider the changing strategy towards consumer business as a perpetual thing? Means in a way it will be going forward the same approach we will keep to have a relatively lower focus on consumer business, and the margin focus will remain higher. So is that the strategy? Perpetual change in the strategy, should we assume that? Question number one. And question number two is, there is a material increase in the debtor days, and largely it is attributable to higher margin business also. So will that also be in a way permanent change in terms of the working capital numbers as well? That is the second question. Yeah, that's it from my side, and thanks for the great set of numbers.
Okay. Now, as a strategy, yes, we would concentrate on the high margin businesses, higher margin vertical more in the coming years, this year and coming years. High volume, very low margin consumer business would be slowly and steadily brought down to 30%. But this does not mean that the consumer segment, the sub-vertical in the consumer sector, which is my own design and manufacture, that will be a focus for the management. So when we say the overall consumer business has come down to 35% this year, it also includes my own design and manufacture and other products which I give to the consumer segment, which are comparatively higher margin. The focus will be on higher margin business, irrespective of the vertical. Consumer also has a sort of a vertical within it, which is decent margin business. It's only the high volume, low margin business which would, in a structured way, be brought down. Coming down to your working capital level, when we were at 40% consumer business, high consumer business, we were at about 70 days. We have brought down the consumer business to 35% and we are down to 69 days. So the focus of the management would be to control the working capital in its totality. Yes, when we do industrial, when we do exports, when we go into railways, the working capital cycles are comparatively elongated. But with efficient management of resources and production, I think we are in line to reduce the working capital further. Just for clarification, these are what the working capital figures are without any factoring or off-balance sheet adjustments. Bijay will run through the details.
So you are right there, Anil. Primarily with the high margin business, we may have to deploy certain high receivables, but that is all backed by high payables also because we negotiate the business accordingly. And going forward, we are further targeting to bring it down at receivables and payables level. In fact, along with the overall reduction at the NWC level also.
Okay, sure. So this is very helpful. Just second line, last question. If you can indicate a bit more on the QIP plan and also the bare PCB business that we are planning to start under new wholly owned subsidiary. So what are the timelines where the new plant will be, and in a way, what are the incentives, state incentives, central incentives that we are looking at? And in a way, if any customer details, client details, if you can share. So whatever business plan you can share at this stage. Yeah, thanks.
The QIP is just a revalidation of the QIP, which is a permission, the authority which we had taken from the board last year. So that was expiring in about a couple of months. So we have taken sanction from the board of a QIP. This QIP would be used, one, if we do an inorganic acquisition, and that's what we had shared last year. So it's an enabling resolution to have funding arrangements ready. Second, if we go, and rather not if, when we go into component manufacturing under the Government of India's component scheme, which has recently been announced, we'll share with the street once we have something concrete. It could be used for that, and then the remaining is the general purpose working capital and other things. As of date, there is no fixed, concrete proposal on the table to say this much is for this much is for that. That we'll share once we have the details. I hope that answers your question.
Yes, sir. That is helpful. And any other details that you can share on the bare PCB business that we are looking at?
See, we are looking at components in totality, and bare PCB is part of one of them. As of date, there's no concrete proposal which has been approved by the board. We are evaluating various piece parts which are in the component policy. PCB is part of that, But as of date, there is nothing finalized or concrete on the table. We are evaluating and discussing. And we'll share with the street once there is something concrete, once we have concluded.
Okay, that's fine, sir. And I missed the revenue guidance that you share for FY'26. I understand margin you have indicated around 8%.
Yes, 30-35% growth with about 8% margin profile.
Okay, sure, sir. Thank you.
Thank you. We take the next question from the line of Sonali Salgaonkar from Jefferies. Please go ahead.
So thank you for the opportunity and congratulations on a great set of margin growth. So my first question is actually regarding the new component manufacturing scheme which is being rolled out by the government, ECMS. Tentatively, as of now, which would be the areas of interest for the management to apply? And in that conjunction, what would be the kind of capex that we would be looking forward in FY'26 and 27?
Under the component policies, we are evaluating components, whether they are electromechanical, wound components. There are something like camera modules, PCB is one of them. Connectors also are there. As of date, there are 3-4 verticals which our teams are working seriously on. And we are looking for tie-ups and other things. Once we have a detail, then we'll share. But broadly, the component ecosystem has to be developed in India, and we are very seriously evaluating that. And I think we should be participating in the scheme. There's still a window of about 80 odd days or 78 days till 31st of July to file the applications. Again, what we are very, very mindful of is that wherever we go in, whatever sort of component we go in, we must go with a very credible, reputed technology partner. I think that's the underlying philosophy of the management and the group, that we should have credible partners which are very well placed in the vertical we would like to go.
On the capex again, overall capex varies depending upon which component we select and maybe how much of the capacities we plan to put over there. Broadly, we can see the capex varies from maybe around 300-400 crore to almost 1,000 crore also here.
Great. So this is very helpful. So my second question is regarding the exports. Now, clearly, we are one of the key players exporting to geographies across. So any thoughts on the US tariff? I know there is a 90-day pause, but any thoughts therein or how the exports will shape up going forward?
See, exports have been muted in FY'25, as shared in my opening comment. In FY'26, based on the orders which we have and the guidance which we have received from our customers, we would be able to cross the 1,000 crore mark, which will signify almost a 23% increase. Tariffs are still in a fluid and a nebulous stage. How would it pan out? No one knows. So despite that, we are expecting a growth of about 20-22%. I think we are working very closely with our customers and other stakeholders, and I think we'll navigate once some semblance of a clarity or stability emerges on it. Stinder, anything would you like to add?
No, I think we have been in close discussion with our customers, meeting them in person as well as having regular touch points with them, closely following their strategy. And I think as of today, the tariff is frozen. So once the administrations are making a decision on which direction they are taking, we will work closely with our customers to support them in their strategy. But clearly, as Mr. Gujral said, we see our exports growing this year compared to what we did in the last financial year.
And just to add on to what Stinder is saying, our judgment or our assessment is that India would not be negatively impacted by the tariffs. So we don't see a situation where India has high tariffs than the competitive countries. Tariffs will come, but India would still have a headroom in that. I think India would be taxed at a comparatively lower tariff rate than the competing countries. That's our assessment.
Understood, sir. Very clear. And just one last question from my side. We completely understand that you want to transition from the lower margin consumer business and yet grow our top line. So which would be the top two sectors who would contribute to the revenue more than the consumer? Would that be industrial and autos? Is this understanding correct?
Yes. Our major growth drivers are industrial and auto sectors, along with the exports, which we just talked about. So these three will be the major drivers for a top-line growth next year.
So would exports be margin accretive as well?
Yeah, they are.
Okay, sir. Thank you and all the best to the team and congratulations once again.
Thank you.
Thank you. We will take the next question from the line of Pranjal Jain from Morgan Stanley. Please go ahead.
Thanks for taking my question. So you did mention in the opening remarks that we have added around 20 to 25 new customers, which are likely to see some revenue booking from FY'26 onwards. With that in context, which are these key segments that these new customers cater to? That's number one. And which are the sub-segments that are driving growth in industrials segment in particular?
Majority of our customers are in automotive and industrial. So if I would look at it, 3/4 of the customers are between automotive and industrials. And that's in line with our strategy. That's where our major focus will be.
And on your question on the sub-verticals within the industrial segment, in domestic segment, the industrial would be driven by the energy metering. Globally, it could be power electronics, a large format box build for various applications, including EV charging and power supplies. Utility metering globally also would see a growth traction in this year. So it's a very broad, wide mix. Automotive will be driven by primarily EV and acquisition of more customers in the ICT space.
Sure, sir. That answers well. And secondly, what would be the PLI incentive that we may have booked in the full year of FY'25?
So approximately around 35-36 crore is what we have booked for the full year.
And could you also help us with the Q4 in specific?
About approximately 8 crore rupees.
Sure. That answers my questions. Thank you, sir.
Thank you. We take the next question from the line of Bhumika Nair from DAM Capital. Please go ahead.
Yeah, good morning, sir, and congratulations on a good set of numbers. So my first question is on exports. I know you spoke about exports being a strong driver of growth next year. And, we were looking at US to kind of support that, but given the tariff situation, one is on a wait and watch out there. Could you throw some color in terms of how is Europe sales really going or other parts of the globe which is supporting our confidence in terms of the growth aspect out there as we look at next year?
See, two parts. One, my growth in the sales will be driven by some customers which saw a 4, 5, 6 month window of revenue last year, and I'll see a 12-month window of revenue this year. So that is almost like a 100% jump in the revenues from those customers. Because if I did a customer for 5 months and I do it for 12 months, there's an incremental revenue. On Europe specifically, it has been muted thus far. We have now seen a slow rebound in order inflow, which points that towards the end of this calendar year, Europe, we would see it back to what we were there in 24. See, we have maintained 863 crores of revenue, up from about 800 crores last year, on the back of a very subdued demand from EU. So my customers, additional customers, offsetted or compensated me for the decline in demand or revenues from the EU customers. We have now started seeing a upturn on this. And the new customers which we onboarded and the orders which we have got, the visibilities which we have got, gives us the confidence that if the things were to pan out as they are currently panning out, we should cross the 1,000 crore mark in the coming year. It will also be aided by healthcare. Though healthcare business is small, but it will also be aided by healthcare business. This is if, again, I give it a caveat that if things pan out as they are, if tomorrow something out of the world was to happen on terrorists or something which none of us estimate, then it would have a different impact. But under the normal circumstances, we would achieve the 1,000 crore mark. And I've shared you based on rebound in Europe, some customers which saw revenues kicking in second half of FY'25, having a full 12-month window, and some new customers which we have added, which would see some months of revenue this year. All these three factors put together would sort of take us to cross the 1,000 crore revenue mark, and we are very confident on that.
Sure, that helps, sir. So my second question is on industrials. We're looking at a very sharp growth out there and, percentage contribution also kind of improving. A lot of the growth is also driven by the domestic segment where, the energy meters will play a significant role. Now, how large is this, segment for vertical for us? Are we seeing, decent traction out here, or are there delays in terms of execution on ground, which could possibly impact into the second half? So just trying to understand this vertical out here.
Are you referring to the smart metering business or the industrial in general?
Yes, sir.
Okay. See,
smart metering within industrial, sir.
Yeah, within smart metering business, or I would call it utility metering business within the industrial, is a significant component. And just as a reference point, I was looking at the figures. We did about 3.9 or 4 million units of energy metering electronics in the year gone by, and we expect that traction to continue in this year also.
And this would be what growth in 25 when we are saying 4 million, close to 4 million number in FY'25?
I think it will grow. Overall industrial, as I shared earlier, over a 4-year period, it has grown by 29%. Incidentally, last year also it has grown by about the same percentage. We expect this business to continue to grow. Now, whether the smart metering business grows by 20% and gets the other components in the power thing, large box build, format build, fuel dispensing, power supplies, power controls, solar. So all these things put together, we expect what Vijay had shared, that we have targeted a growth of about 29, 30%, 30% plus in the industrial segment. So it will be a blended mix.
For FY'25, the similar utility metering business would be approximately 300 crore plus.
Okay. Got it, sir. This is helpful. Lastly, on the, bare PCB board business that we are looking to get into and evaluating, would we kind of be doing this on our own? Are we planning to do some tech partnership? Any color on that business would really help.
On what thing?
On the bare PCB board business, sir.
See, again, I said bare PCB is part of the component policy, so let's not be specific to bare PCB. Whatever vertical we enter, whether it is the bare PCB or the components, whether they are magnetics, wound, if we believe that we have the in-house capability to do it, it will be done in-house. Wherever we believe that having a partner would be worthwhile, so it will be with a partner. What contours that association takes place, we'll come to know once we sign off an agreement with the potential partner, whether it's a JV, financial JV, technical JV. So those are all things under discussion today. But one thing is clear that we would be participating in the component PLI. What particular things, these are still under discussion, and I'm not at a liberty to sort of disclose and discuss them till they are finalized.
Sure, sir. Great, this helps. Thank you very much and wish you all the best.
Thank you.
Thank you. We take the next question from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Yeah. Hearty congratulations, Gujral sir. I just had a comment to offer and would like to have a response from you on that. I think our business model is now acquiring much more solid and concrete shape. Earlier, perhaps, the business was, the turnover was an outcome of the order book and availability, where growth of the top line seemed to be number one priority. Now I think balancing the business with healthy profitability, capital efficiency, working capital management, and carefully balancing overall business so that business becomes an outcome of the business model rather than the other way around. Would you say that is a fair comment as to how we have evolved in, let us say, last 2 to 3 years?
Yes. If you sort of just scan over the last 2-3 years, for about a year and a half, we had a very high component of the low margin, high volume consumer business where we were not present earlier. So it was a new sort of dish for us. And we are now recalibrating, or rather we have recalibrated our strategy to refocus on our core competencies. Though manufacturing of high volume consumers is also, we have developed that core competency and we are comparable to the best in the industry today. But having said that, we have recalibrated our strategy to focus on comparatively higher margin, design, engineering-led manufacturing, which was our core competency pre-22. So you're right, we are refocusing that to focus on growth in these high verticals. And as I said earlier, Bharatji, there are no free lunches. If we have to focus on margin accretion, industrial, automotive, they have a certain growth trajectory, unlike the consumer, which is a low-hanging fruit and could have a very high growth trajectory. So we will continue to concentrate on industrial, automotive, healthcare, and design-led manufacturing, which will have some impact on the top line, but on the bottom line and other things, it will be all positive.
And presumably greater focus on technology, which is our own ODM business, carefully chosen and selected, and improved margins with a discipline on working capital. All that should lead to measurable improvement in capital efficiency?
Yes, please. But these high margin businesses have an elongated working capital cycle as a nature. But I think with a proper focus and control and empower teams, we should be able to maintain, rather reduce the working capital cycle, which we have thus far achieved, which is about 69 days. Despite these high margin businesses going up, which have a longer working capital cycle, I think we are in a position to bring down the working capital cycle further.
One question for Vijay Agarwal. Vijayji, the PLI incentive likely for the coming year, if there is any computation done?
So this is all varying actually based on the overall how much of consumer and specifically telecom consumer business we are doing in the next year. We can say based on the order book visibility, this income can be somewhere ranging between 15 to 18 crore rupees for the next year also.
15 to 18 crores for the company in entirety.
FY'26, yes.
Sorry, 15 to 18 crore in entirety for the company.
This is like what the company can retain post sharing if there is anything. This can reflect in the company's going forward also.
Compared to 35 crore booked in the FY'25, you're saying about half of that number is likely for the company in entirety.
Yes.
Okay. And I presume depreciation probably would grow marginally for the next year. I think most of the capitalization has occurred. Am I right?
That's right. Most of the assets have already, CapEx is already done, capitalization is already done, so we don't foresee much of increase in the depreciation going forward, barring normal standard.
Okay. And interest, which is about 58 crore for the last year, would you say, of course, it will grow less because of then the top line growth because of the rate of reduction likely, plus the reduction in working capital. But would you say it will be the growth in interest costs will be much lower than the top line growth of 30-35% that you have talked about?
Yes, that's what we are targeting for. We don't expect that much of straightforward linear increase in the overall borrowing level, and this interest cost is primarily linked with the borrowing level only. So we expect a better improved cash flows going forward. With that, this increase in the finance cost will be much lower.
To be much lower than the top line growth.
Yes, absolutely.
All right. All right. Thank you, and best wishes.
Thank you.
Thank you. We take the next question from the line of Viprav Srivastava from Phillip Capital. Please go ahead.
Yeah. Hi, I'm audible, right?
Yes, please.
So quickly on a question on the P&L. So the other expense for the last 4 quarters doesn't add up if we consolidate with the full year other expense. Can you explain the reason for that?
Vijay?
You can send the query separately. We can check and reply back on that thing if there is a regrouping.
It could be because of regrouping in the quarter or something like that, but you said other expenses?
Yes, other expense. Yes, sir.
Okay.
Sure, we will take it offline. Yeah. No worries, sir. So quickly on the order book. So obviously as Vijay said, we currently have an order book of around 5,200 to 5,400 crores. So will it have an execution timeline of 14 to 15 months? Is that right?
It varies up to 18 months also. Few of the businesses may go beyond 12 months also.
So, sir, I mean, if I divide that number by, let's say, 1.25, assuming it to have an execution period of 15 months, the growth trajectory which you have shared doesn't add up. So are you expecting to win more orders, short-term orders, which will lead you to achieve that target?
Yeah. You see, it is not that the orders which you have got on 1st April would only constitute the revenue for the current year. What we have shared is the orders which we have, another thing. During the course of the year, the visibilities which we receive and the new customers which we get, we keep getting the revenue, sir. So it's not that only opening orders as on 1/4/25 would form the basis of the revenue for 25-26. It is the orders in hand as of 31st of March or 1st of April, plus the orders which accrue during the year. We had guided the same figure last time. What was the figure last time which we had guided?
5,300.
Just one comment on this. Different customers behave differently. Some customers give you order for a couple of months. Other customers give visibility for the whole year or even higher than that. So it's a combination of different customer behaviors.
Right, sir. So you're expecting short cycle orders in coming months, and that leads to a confidence in the target, right?
Yes, there will be orders continuously coming in. As we go through the year, it will keep coming in. we'll keep fulfilling the orders, and the new orders are coming in from the customers.
Sure, sir. And so lastly, on the smart metering side, obviously the utilities, what we are hearing from utilities is that a lot of these installations are not happening at a great pace. So what are your thoughts from the ground view? Are you seeing the installations happening? What are your clients saying on smart metering?
See, end of the day, we supply to the metering companies, and what we are expecting and we are witnessing is a robust demand from that. There could be monthly, quarterly bits. For example, if one of my customers has an order and where his installations are not happening, obviously he will then slow down in one quarter and then ramp up in the next quarter. But on an annualized basis, we expect this business to have a robust growth. We witnessed it over the last 12 to 15 months, and we are, by the way, one of the largest electronics EMS companies in the country providing these metering devices, not now, but for the last 18 years.
Okay, sir.
But we are very selective with our clients. We are very selective with our clients because the end customer being the government, the working capital cycle is long enough, and we are very mindful of the financial credibility of our customers. The business can grow much faster if we just pick up the customers where our working capital will subsequently get stuck up. So we are a bit choosy on the customers in this segment.
Right, sir. And sir, last question, if I'm allowed to ask, what percentage of bill of material will be contributing in smart metering? I mean, the final box is around 5,000 rupees, so your contribution will be around 3,000. Is that correct, or is it less or is it more?
Oh, no, it's not 3,000 rupees. I think the smart metering value would vary from 700-800 rupees to 1,200, 1,500 rupees, nothing more than that. The electronics, we do only the electronics. We don't do the electrical, we don't do the plastics or the box build. Shunts and other things we don't do.
Okay, sir. Thank you. Thanks a lot. Thank you.
Thank you. We take the next question from the line of Mahesh Chavan from iWealth Management. Please go ahead.
Hello, sir. Am I audible? Hello?
Yes, please.
Hi, sir. Congratulations on good set of numbers. Two questions were there. First question was, from the consumer side, what percentage of RFID module contributes in the consumer business? And another question was, in the the segment bifurcation, which you mentioned that the consumer segment will be going down from 35% to 30%. Can you just repeat the bifurcation for other segments as well?
RFID business would be approximately 8%, 7.5% to 8% of my total business, company as a whole.
Mm-hmm. Okay, sir. And segment bifurcation going ahead for FY'26 and 27?
FY'26 also, we are expecting the overall RFID business will be somewhere in the range of 8 to 10% only. That's what we are guiding right now.
No, I meant the overall, like the consumer segment, which you said right now it contributes around 35% of total revenue. Right. In FY'26, you are saying that it will scale down to 30%. So similarly, I wanted for FY'27 as well.
See, FY'26, we said consumer business will be around 30%. We'll try to bring it down to 30%. And I think we'll retain it at about 30%. It may come down slightly more, between 25 and 30%. But our endeavor would be to fill up that gap with our own design products in the other consumer segment. What we are referring to is a high volume, low margin consumer segment, which is part of this consumer business. That will come down. But I think in 26, 27, the consumer segment in totality would be anything between 25 and 30%.
Okay. Thank you so much. That's it from us.
Thank you. Ladies and gentlemen, in the interest of time, that was the last question. I would now like to hand the conference over to Mr. Gujral for closing comments.
Thank you, everyone. I think we have had a good year in FY'25, and we expect to continue this good work going forward in FY'26 and 27. The figures and financials have all been discussed. What the objectives we have for the management is to, again, as I've always been saying, to have a sustainable organization which can continue to deliver returns to all the stakeholders. ESG is very, very important for us, and we have a separate team monitoring our ESG performance. And as I shared with you, we are among the top 35% companies globally adhering to the ESG standards. Going forward, this effort will be further doubled up. We have our capacities in place, and as we had shared last time, we are now planning to grow on a campus model rather than a standalone unit model. Efforts for the long run, 25, 26, 27 is short run. For the long run is to move up the value-added chain through ODM, which currently in this year was, I think, about 12% of our revenues. And I had shared last year that we internally believe that we should be at about 25%, which is a very, very tall task. But I believe that in the long run, this 12% should grow up. And once this goes up, along with the export and growth in the other verticals, high margin verticals, we are on track to deliver sustained growth at superior EBITDA margins than what we have been delivering in the past. Focus will be on generating cash flow, working capital, capital efficiency, and organization building. And we would, as I said, in all probability, seriously we are evaluating to participate in the component PLI. So to make India an electronics hub, we would like to participate in that scheme of the Government of India and the Honorable Prime Minister with all our sincerity and efforts. Thank you very much.
On behalf of JM Financial Institutional Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.